Stop chasing your tax strategy to qualify for a mortgage. I mean it. If you are self-employed making good money and you've been told to show more income on your taxes for the next 2 years before you can buy a house, you've been given the wrong prescription for the right problem. And I see this play out the same way almost every single time. Quick note, if this is your situation right now, there's a link in the description where you can book a free strategy call with me directly. No cost, no pressure. Okay, here's what's actually happening. You run a successful business, you make over 200 grand a year. Your CPA is doing exactly what you're paying them to do. They're writing off vehicle expenses, home office, meals, depreciation, supplies, contractors, all of it legally correctly. That's smart tax planning. But then you walk into a bank or you call a lender to buy a house and they pull your tax returns and they say, based on your Schedule C, you only made $47,000 last year. And you're sitting there thinking, I deposited $18,000 a month into my account. How do I only make $47,000? And that's the moment where most people do something I find genuinely fascinating from a behavioral standpoint. Instead of questioning the tool the lender is using, they question themselves. They call their CPA and say, we need to stop writing things off. They literally volunteer to pay tens of thousands more in taxes, sometimes for 2 full years, just to get a piece of paper that will show a higher number to a system that was never built for how they earn money. Think about what it actually costs. If you claim $60,000 or $70,000 less in write-offs per year to increase your taxable income, you're in a combined federal and state tax bracket likely north of 30%. And you could be handing the IRS an extra $20,000 or $25,000 a year. Over 2 years, that's $40,000 to $50,000 out of your pocket. Not because you needed to, but because you were told there was only one way to qualify. Here's what nobody explained to you. The conventional mortgage system, Fannie Mae and Freddie Mac, the one most lenders use, was designated for W-2 employees. People with a paycheck, a pay stub, a single number that matches a tax form. It was never really designed for somebody who runs revenue through a business, pays expenses, takes deductions, and deposits the rest. When a conventional lender uses your tax return, they're looking at your net income after every single write-off. That is the system working as intended. It's not broken. It's just not built for you. And here's where it gets really interesting. The part that most people never hear about. There's an entire category of loans called non-QM loans. And non-QM stands for non-qualified mortgage, which sounds scary, but all it means is a loan that doesn't follow the standard Fannie Mae and Freddie Mac underwriting rules. It's not subprime. It's not predatory. It's a different set of guidelines designed specifically for people whose income doesn't fit neatly into a W-2 box. And within that category, there's a product called a bank statement loan. A bank statement loan lets you qualify using 12 to 24 months of your actual deposits instead of your tax returns. No Schedule C, no 1040, just the money flowing into your account. Here's how the math works. And I want you to actually follow along because you can do this yourself right now. Pull up your last 12 months of business bank statements, add up every business deposit, not transfers between your accounts, just actual business income deposits. Divide that total number by 12. That gives you your average monthly gross deposit. Now, when a lender underwrites this, they apply something called an expense factor. Think of it as a lender's estimate of how much of that deposit goes into running your business versus what's your actual income. There's a standard default expense factor of 50%. So if you're depositing $20,000 a month, your lender credits you with $10,000 a month of qualifying income. That's $120,000 a year, way more than the $47,000 that your tax return actually showed. But actually, let me back up because this is important. If your business expenses are actually lower than 50%, and for a lot of service-based businesses like consultants, coaches, freelancers, tech professionals, they absolutely are lower than 50%. Your CPA can write a letter documenting your real expense ratio, And if your CPA says your actual expenses are only, let's say, 30% of revenue, the lender can use that number instead of the 50%. Now your $20,000 a month in deposits become $14,000 a month of qualifying income. That's $168,000 a year. On your tax return, still says $47,000. Same person, same money, completely different outcome. Just a different measuring tool. If you want help figuring out what this looks like for your specific numbers, book a free strategy call. The link is right below this video. I'll personally look at your situation and I'll tell you where you stand. Now, here's who this is for and here's who's it's not. Bank statement loans are built for self-employed borrowers who have been in the business for at least 2 years, have decent credit. Most programs start at 620, but you'll get a much better term over 700, and you can show consistent deposits. They're perfect if your tax returns drastically understate your real estate income or your real income because of legitimate write-offs. They're not a good fit if you've been self-employed for less than a year, if your deposits are wildly inconsistent month to month, or if your tax returns already reflect your full income accurately. In that case, a conventional loan will give you better terms. I had a client, a consultant, made great money, had been told by 2 different lenders that she needed to show more income for 2 more years before she could buy. She came to me and I looked at her bank statements, consistent deposits, clean accounts, solid credit. We ran the numbers through a bank statement program and she qualified for significantly more than the conventional route ever would have shown. She closed on her house within 30 days, no changes to her tax strategy, no paying extra tax for 2 years, same money, different tool. Okay, so here's what I want you to actually do after watching this. Step 1, go pull your last 12 months of business bank statements. Most banks let you download this from an online portal. Add up every deposit and divide by 12. And write that number down. That's your average monthly total deposit. Step 2, think about your business expenses as a percentage of your revenue. If you're a service-based business with low overhead, no inventory, no warehouse, no large staff, your real expense ratio might be just 10, 20%, maybe 40%. If you're not sure, ask your CPA. They can calculate this from your books in about 15 seconds. Step 3, take at your average monthly deposit, subtract your expense percentage, and look at what's left. If that number is strong and consistent, you're very likely a good candidate for a bank statement loan. Write that number down and bring it to you when you talk to me. The decision rule is simple. If your bank deposits tell a very different story than your tax returns, you probably don't have a tax problem, you have a lender problem. And you fix a lender problem by finding a lender who has the right tools. If this has helped you see your situation differently, do 2 things. Book a free strategy call with me using the link in the description. I'll review your numbers. I'll tell you exactly what your options are. And then second, could you hit subscribe? Because I'm going to keep making videos like this that give you the real information nobody else is covering. Let's get started together.